what were the expenses and what has been the profit, simply put, right? Of course, it is much more detailed than that, and we will discuss in later learning modules what is the full format of the income statement. But at this stage, I just want you to get a high level overview that the balance sheet, also known as the statement of financial position, is a snapshot. It just tells you what are your assets, what are your liabilities, and what is your equity, the value of your company. This cash flow statement just shows what cash came in, what cash went out, and if you paid any dividends, so your owner's equity will be going down. If you generated any profit, your owner's equity will be going up. And that is shown in your statement of changes in owner's equity. So let's discuss them a little bit more. Your balance sheet shows assets, liabilities, and equity. What are assets? So again, you start a company off with your money, which is equity. You might take some loan from the bank, which is a liability, and then you might invest that money somewhere, and those are your assets. So assets are what the company owns. As far as the company is concerned, it got its money. What are the sources of money for the company? They are the equity, the directors, what the directors or the shareholders have provided, or what it got from the bank. And then the company then invests that money into some resources, and the company owns these resources. So the assets are what the company owns, and the liability and equity, which were the sources of this capital, of course the company owes this back to either the shareholders or the creditors. And within the sources you have both liability and equity. So this is owed to creditors, whereas your equity is owed to shareholders. And this brings us to the famous accounting equation that assets are equal to liabilities plus owner's equity, and this will always be balanced, right? If you will have a profit, your owner's equity will go up and your assets will go up. If you will pay dividends, your owner's equity will go down and your assets will go down. If you will take a loan, the assets have to go up in an equal amount, because whatever you do with that money, it is going to increase your assets. It has to increase your assets. If, let's say, you take a loan and you make a loss, so the increase in your loan is not equal to the increase in your assets, then the loss hit is going to go to the equity. But either way, the equation will stay balanced. So what is the capital structure? Capital structure is how much debt you have and how much equity you have. So clearly assets are being financed by liabilities and equity. But the question is, if you have assets worth 100 million, how much of that is coming from liability and how much of that is coming from equity? If it's coming equally, then we will say that the capital structure is 50% debt, which is your liability, and 50% equity, which is a relatively healthy capital structure. The more capital structure is inclined towards debt, the higher the financial risk, because debt obviously has to be paid interest to, and it's not an optional thing. You have to pay interest on time. It is a contractual obligation. Whereas equity is paid dividends, but that's not contractually obligatory. So what we want to see is, when you're doing your analysis, is that how much debt does a company have. If it has very high debt, then we definitely are going to be very careful in investing in this company, especially if we are looking to give it a loan, because if it already has a lot of debt, then it is very dangerous to give that company further debt. And even if we are looking to give them equity, we should realize that it is a highly risky investment, because with high levels of debt, the assets will first be used to pay off the debt, and then anything can be paid to equity holders. So naturally, we will have to then account for that higher risk. All right, so the balance sheet is very useful. It gives us a perspective into what is the financial position of a company, but it does not tell us what is the profitability, right? For that, we have to go into the income statement, which tells us what is the sales being generated by this company, what are the expenses, and of course, what is the resulting profit and loss. And naturally, if you take your revenues and you minus the expenses, you get your net income. Next, cash flow statement, also very important, because as you might remember from your quantitative methods sections, that whenever we calculate the present value, it is based on cash flows. So similarly, if we are going to talk about a stock, a company's stock, and we want to calculate the value of that stock, this will be the present value of its future cash flows. And therefore, as an analyst, okay, the balance sheet is important for you, the income statement is very important for you as well, but at the end of the day, it all comes down to the cash flow statement, because our valuation is based not on the balance sheet, not on the income statement or future earnings. It is based on future cash flows. So based on your analysis of the balance sheet and income statement, at the end of the day, what really matters is what is your projected cash flow statement, and that is what is going to help you come up with the projected cash flows, the future cash flows, and that discounted to today is going to give you the stock value. But you are going to learn a lot more about this in the rest of your financial statement analysis and in the rest of your equity sections and in your corporate issuers sections as well. But just wanted to emphasize on the importance of the cash flow statement, that even though you might be thinking, oh, balance sheet tells us financial position, how important, income statement tells us the profitability, how very important. Yes, those two are very important, but they are only a means to an end. The cash flow statement is the one that is going to help you finally come up with the value of this company's stock. Now, the cash flow statement is divided into three elements: operating, investing, and financing. And as stated earlier, all of this is going to be discussed in a lot more detail in subsequent learning modules. So just take a high level understanding over here. Operating is going to show the cash flows from the day-to-day activities, their operations, cash coming in from normal customers, sales, cash going out to suppliers, salaries being paid to employees, staff, right? Investing cash flows is when you're buying fixed assets like property and equipment, or buying or selling of these long-term assets. And financing cash flows are where you're getting money, you're getting capital either from equity holders or from debt holders. So new loan coming in or loan being repaid. So money coming in and going out from your providers of capital or back to your providers of capital is going to be showing under your financing cash flows. Finally, we are coming to the statement of owners, changes in owners' equity. So if you will be paying any dividends, naturally your equity will be going down and so will your assets, and that will be shown in your statement of changes in owners' equity. If you will be generating a profit, it will show in your income statement, and it will increase your retained earning in your balance sheet, right? And it will show up in your statement of changes in owner's equity. So again, if you pay dividends, it is going to show up in your balance sheet how your equity will go down, your assets will also go down, and it will show up in your statement of changes in owner's equity when you will pay the dividends. It will show that dividends have been paid and equity has gone down. If let's say you generate profit first of all, of course, it is going to show in your income statement. And then it is also going to impact your balance sheet because your equity will go up and your assets will be going up with the amount of the profit. And it will show up in your statement of changes in equity that your equity will be going up. So again, all of this will be covered in detail, but what this is called is retained earnings, which increases with profit and reduces with dividends. And paid in capital is what the company is started off with. Now, all these financial statements are the main ones, right? The ones which have been mentioned above. Your balance sheet, your income statement, your cash flow statement, and your statement of changes in owner's equity. But there are other additional information that are provided. And what are those additional informations? Footnotes. Because it's very, very important to know the details of these statements. Such as, let's say, in your income statement, it is showing that there has been a certain depreciation of your equipment and the amount has been shown as $1 million, right? Now, what is the basis of this depreciation? And if we've not discussed this before, let me give you a high-level introduction into what is depreciation. Because it depends if you've seen the corporate issuers videos yet, because it is discussed in corporate issuers. But if you have not, well, I can tell you now that depreciation is whenever you buy a long-term asset. Let's say the company has bought a factory equipment, right? And it's going to realize the cost of this factory equipment over 10 years because it feels that the useful life of this equipment is 10 years. Every year, and let's say they bought it for 10 million, right? Every year they're going to record an expense of 1 million so that they distribute this expense across the 10 years in which this machine is going to be used. So all of this assumption has to be declared in the footnotes that this is the assumption that this machine is going to have a useful life of 10 years. This was the original cost, and therefore this is the depreciation recorded for this year. And there are many other examples I can give you, but when we will get to all the relevant areas in the upcoming learning modules, then we will be talking about all of this. The other additional information includes management commentary, where management is going to give their subjective analysis. And of course, there is the report of the auditors that goes through the financial statements and gives an opinion on their accuracy. So what are footnotes? Footnotes, as discussed, include estimates such as useful life of assets, accounting methods, and building on with the depreciation example, that whatever is the useful life, let's say 10 years of a certain machine, you could do it in terms of straight line, you could do it in terms of accelerated method. And don't worry about this, all of this will be discussed in detail. I'm just giving you an example that even the depreciation you can equally divide across the 10 years. That is called the straight line method. Or you could do accelerated method, in which you will do higher amounts of depreciation in the earlier years and then lower amount of depreciation in the later years. So there are different accounting methods that can be used. Whichever method the company is using, whatever estimates they are making and whatever assumptions they are having, they need to be told to the users of these financial statements through the footnotes, right? Any other information regarding acquisition or disposal, if there are any commitments or contingencies which are off balance sheet, that they are not showing on the balance sheet but they are contingent on some event happening. Let's say there is a court case going on, and if the company loses that court case, there is going to be a big loss. So naturally the balance sheet will be impacted, right? So legal proceedings, contingencies, any kind. Or for example, another example of contingency could be, let's say if you have given some bank guarantees, if you're a financial institution and you have given some bank guarantees for your clients, and if those clients lose their court cases, then you will have to then pay up on those bank guarantees, and therefore it is going to be a contingency for you. If you've given stock options to your employees and if the stock goes up, so let's say currently your stock is at $50 a share, and you've told your employees, your senior management, that you can buy the company's stock from the company at 60. Now obviously if the stock will go up to 80, then these management members are going to want to buy at 60 and sell at 80, which means you are going to have to give them something worth 80 at 60, and it is going to impact your balance sheet. So all of this needs to be told to the users of financial statement. If there is any business activity going on between sister companies, right, related parties to your business, they need to be disclosed as well. Management discussion and analysis, also a very important part of your financial statements. This is where your management gives their view, their perspective about how the business is going, what are the major trends, any significant events, right? How do they see things going forward? Very, very important to help us analysts understand the financial statements. Then the auditor's report. Now, these are independent bodies that review the financial statements, and they express an opinion on the fairness and reliability of these financial reports. Now, the opinion can take 4 types of situations: 1, 2, 3, and the 4th one is basically that they were unable to give an opinion because the situation is so terrible. Now, the first one is the best. Unfortunately, it doesn't have a very nice name because, of course, qualification is a good thing and unqualified seems like a bad thing, but this unqualified is actually the best opinion. This is the cleanest or unmodified opinion actually. So unmodified is a better name, clean is a better name, but unqualified doesn't really let us think that, oh, is this a good thing or a bad thing? Well, you have to remember that unqualified opinion is actually the best one, which basically means that the auditor is giving you a reasonable assurance that these financial statements are fairly presented. Now, if the auditors notice something little bit out of the ordinary, what they will say is that we are giving a qualified opinion, which means they believe there is some, not a lot, but some misstatement, and they will also indicate what is the area in which they believe there is some misstatement. Then something which is worse than a qualified opinion is an adverse opinion, where they feel that the financial statements are not fair. So they are not presented fairly and they are departing or different from what is required from the accounting standards. And then, of course, the worst situation could be that there is a disclaimer of opinion, that they will just say that we are unable to give an opinion because either the company didn't let us check properly or for some other reason, but this is the worst situation that can be there as far as an audit report is concerned. And within the audit reports, they also highlight certain areas. They are either called key matters, key audit matters as far as IFRS is concerned, or critical audit matters as far as US GAAP is concerned. And these are the areas in which there is a higher risk of misstatement, right? Because significant judgment of management and estimates are involved. And again, think of the useful life and such estimates, right? So because there is a subjectivity involved over here, the auditors highlight this so that the users of financial statements can be more careful with respect to these areas. And finally, what are some other sources of information? These financial statements are of course shared annually, which are audited, but you can also find quarterly and semi-annual reports as well, but those are not audited. And there is also sometimes where a company is having something put up to a vote to its board members or to its shareholders, and when that happens, they also provide information to the shareholders about what is being put to a vote, and based on those publicly shared informations, which are called proxy statements, you can also include them in your analysis. Alright, so we're going to stop this video here, and in the next one we're going to compare IFRS with other reporting standards such as the US GAAP.